Okay, yeah, I think people will probably miss the Adyen update because we normally go through this one. It's kind of a religion for Steve and I. But this was the report that came out last week, I think. The initial reaction to the stock was a 20% decline, which was a bit of a shocker to wake up to in the morning. Before the close of play, though, it was only down about 5.5%. It had made a monumental climb back. And I think that was just people having time to uh, digest the earnings. So revenue for them was just under 1.1 billion euros, up about 20%. They did about 544 million of EBITDA, up about 28%. That's a 50% margin. EBIT, about 483 million, 29% margin of about 44%. Net income came in at 481 million, up about 17%, a margin of 44%. They generated about 474 million of free cash flow. That was up 32%, and that's a margin of just over 43%. The take rate was up zero point 0.4 basis points. That was 16.8 basis points. In terms of by geography, EMEA was up 631 million, up 21%. North America 292 million, up 20%. Asia Pacific 111 million, plus 15%. Latin America 60 million, up 17%. In terms of processed volume, so when they do processed volume, they give you the amount, and then they give you the amount excluding one customer. Now, I don't think it's any secret that that one customer is Cash App. And if you think about that a little bit, considering who owns Cash App, i.e. Block, that's quite funny that they're using Adyen as a payment provider. But we will gloss over that, and I will, if I say excluding one customer, that means probably excluding Cash App. So the processed volume for Adyen was 649 billion. That was up about 5%. But if you exclude one customer, it was up 23%. Digital process volume 365 million. That's actually down 9%, but up 18% if you exclude one customer. Unified commerce was 189 billion, up 35%. Platforms 95 billion, up 20%. Revenue by type, so settlement fees 729 million, up 23%. Processing fees 289 million, plus 9%. Sale of goods 54 million, up 4%. Others 165 million, up 37%. Not entirely sure what's in that other section. Would have to do a bit more digging. In terms of segment, digital 639, up 10. Unified commerce up 31. Platforms 121 million, up 55. The long-term guide was reiterated. They said to you net revenue growth from low to high 20s, compound average growth rate, which is what they've hit constantly since we've covered them, Steve. EBITDA margin will be over 50% in 2026 as they continue to use operating leverage, and CapEx will be 5% of net revenue. Tick, 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 all the same. Nothing's changed there. Nothing has ever changed. I think they could probably just copy and paste that bit in. Financial performance. So yes, in the call they said net revenues obviously grew 10% first half of the year, driven by strength in content, subscription. This is the digital area, sorry, driven by strength in content, subscription delivery, and mobility sectors, despite slower growth from Asia Pacific based online retailers. Unified commerce revenues grew 31% in the first half. This was due to a diversifying customer base in verticals like food and beverage, hospitality, and entertainment. Platforms was the fastest growing pillar, 55% increase in net revenues. This was driven by a lot of SaaS adoption from SaaS software companies. They said that their EBITDA margin is going to expand again, but they said it'll be a slightly slower rate than previous year due to continued investments in hiring and growth. As I've been telling people since the dawn of time, Adyen is coming to eat PayPal's dinner. Even Cash App knows that it can't use its own payment provider because it's inferior, and it was only a matter of time before everybody realizes PayPal's the same. In terms of growth drivers and strategy, customer diversification, Adyen is actively diversifying its customer base across different regions and verticals to mitigate the risks of Cash App or the one big customer and capitalize on new opportunities. In terms of wallet share, they said that main focus is increasing its share of customers' total spends, the share of wallet, providing new products and services that solve pain points for customers. That's essentially going to be their primary driver of short-term growth. They're adding a significant number of new customers, which is expected to fuel long-term growth in coming years. And this is a result in basically the spending that they've been doing in the sales team, growing the sales team and growing the locations in which the sales team are. They're not focused on monetizing individual products, but on using them to increase customer value. So in turn, they think that'll drive wallet share. So products like Uplift and Protect are part of Adyen's strategy. They think this will help sort of modularize their platform and provide more flexibility and more functionality to their customers, which should help push wallet share along. They were keen to note that they retain full or essentially their big strength is that they retain full control over its full payments infrastructure, including banking licenses, including the direct access to clearing that they've got, including not buying in every different piece of software under the sun and trying to sellotape the whole thing together into a working piece of software that other people want to use. And this allows them to move money essentially around the globe at one of the lowest costs, which they think is a significant value proposition for the customers and obviously an opportunity for them to improve margins. In terms of regional highlights, they said EMEA, there has been a little bit of deceleration there, but it's a key growth region. It's Adyen's most mature market, and it's a significant long-term growth opportunity. In Latin America, they've made investments in both Brazil and Mexico, including a PIX payment method, an acquiring license, and that has started to kickstart some pretty strong growth in the region. In Asia Pacific, they said that growth was slower from Asia Pacific based online retailers, and that's because they sell into the US, which has obviously been a tariff specific problem. But they think if you exclude this specific group of people, this portion of Asia Pacific retail selling into the US, Adyen's growth rates would have been about 2% higher, if that gives you an idea of how big the impact was. In terms of the future, they said they're confident in meeting its guidance for 2026. This is based on the strong wallet share that they've seen with existing customers and a huge pipeline of new customers that they've got. The company's philosophy is to just move quickly and adopt new technologies. They mentioned things like stablecoins. If they said there was a genuine need from their customers, they would look into that route. But they noted that the need for stablecoins is low to non-existent almost, because they already provide fast, low-cost fund transfers through direct clearing connections. So what's the point? It was essentially what I got out of it. It's kind of like somebody was trying to push the narrative of crypto, and they were like, yeah, cool. Why though? It makes no difference to us whether we do it or don't. And that was the thing I got from the call, Steve. It was brimming with confidence as per usual, brimming with competence as per usual, and this is a business that continues to go from strength to strength, Steve.
Yeah, it's very impressive, isn't it? 20% revenue, and then you work your way higher as you kind of go down into stuff like EBIT. There's not an awful lot to dislike here, and the market seems to very much chop between thinking this is great when they report nearly the same thing every quarter, and terrible when they report nearly the same thing the next quarter. I like this a lot. I've never really thought about kind of counter positioning as much of a moat before, because I've never really understood it, to be honest. But counter positioning, for those who don't know, and until quite recently I would have got this slightly wrong, isn't just about kind of doing things differently and being sort of disruptive in a certain way. It's about doing things differently in a way that incumbent things can't copy without incurring significant, massive costs. So I think a good example here is something like Netflix against Disney in a certain way. So Netflix comes over the top with streaming, and in order to compete in streaming, Disney has to incur quite a lot in the way of costs to pull out its kind of linear network stuff and then rebuild in there. Disney has some good assets for doing that, but that doesn't mean that it can do it easily. What it has to do is give up on its current existing operation and give away basically the sales and profits from that in order to try and compete in the direct-to-TV. And that's not easy to do, especially when you have a shareholder base that doesn't like to see things going backwards from their reasonably mature business, as well they might. Anyway, back to Adyen for a moment. You talked about Adyen and PayPal, and Adyen's kind of moaty approach of building out their own stuff from within essentially makes it really, really hard for anyone who is an established business to try and compete with them. It involves quite a big pivot into a different way of doing things. I get the sort of Cash App stuff. I mean, Adyen's very much a kind of business-focused version of PayPal, which aims to be catering to the likes of you and me, facilitating stupid, pointless, small transfers here. And to some extent, good luck to them. To another extent, people say so much ridiculous stuff about that stock. I don't really want it to do very well, but that's me being petty. Adyen wise, though, the way I can't work out whether I would, if I was a company, try and turn an existing incumbent into a competitor or build another one from scratch. I don't really like the idea of doing either, and that speaks to kind of the big strength of the thing. If you take something that has an existing customer base and try and reform it into an Adyen, you're going to end up going backwards before you go forwards, and you're going to annoy everybody, including your investors. If you try and build one from the ground, it's going to be really difficult because it turns out it's quite hard to build all this stuff. Adyen has over years done a very good job of acquiring talent when talent becomes available, rather than when talent is expensive and hard to find and has lots of different offers on the table. So Adyen keeps going from strength to strength. It's hard to find much new to say about this other than to continue to be impressed by the latest direction in which it's going. Take rate goes marginally higher, which is interesting to see. And I guess you can expect a kind of decent bunch of profits into the future. It looks expensive, but I think I'll come back to that thought in a moment. I'll hand over to you first. There is a certain something that says, look, a proper investment is one that you just kind of sit there with and don't expect returns, particularly for year one, year two, year three. But then you suddenly realize in year 10, 15 or whatever, hang on, based on the price I paid for this thing is trading at a PE ratio of about 2. I mean, it's not at that price now because the stock's gone up so much because earnings have grown. But over time, this is one where if you don't look at what the kind of journey there looks like, you could find yourself in a very nice place by the end of it, I think, Steve.
Yeah, I think it's key to note that this company does about, trailing 12 months, you're doing about 1.6 billion in free cash flow. So if you plug that into reverse DCF, put your 1.6 billion of free cash flow in, terminal growth rate of say 2, that's after 10, discount rate of 10, and I've even diluted you by 0.5. They don't dilute by anywhere near that kind of amount. It's about 100 million every half, I think it is, something like that. You're looking at 14% kind of growth rates. If you say, for whatever reason the free cash flow is going to drop to say 1.2 billion, you need about 18% kind of growth to get to make sense of the valuation today. Adyen are telling you they're going to grow at low to mid single digits, 20s. If you want to put in 20 in there at 1.6, you're looking at a big share price lift here, Steve. They reckon it should be around the 2.2 kind of mark, and that's kind of how it's always been for me, Steve. It's not really. It looks expensive on the earnings line because it's a little bit funky of a company. What it is a cash machine in terms of its free cash flow generation, and I haven't really seen a reason. I've never had it pointed out to me in a reason that I've understood anyway why I should value it any differently, really. I don't think it's going to dilute at that kind of rate. It doesn't dilute. Actually, it's one of the best, the best kind of anti-dilution tech companies that I've ever come across. There's a hell of a lot of free cash flow there, Steve. I'll be interested to see exactly where it goes from here.
One of the interesting things about looking at cash flow statements is that it gives you a good picture of where the kind of cash it generates is coming from. And I get kind of wary in a lot of cases. This isn't the case with Adyen, spoiler alert, coming here, when it's coming from the wrong places, as far as I can see. So you want it to be coming out of operations, and it largely is coming out of operations. But I was kind of struck by in sort of 2024, then you've got 1.6 billion in free cash flows, 600 of which, close enough, comes from changes in working capital. And you sort of think, well, okay, sometimes working capital requirements are higher, sometimes they're lower, so you won't always get that push. Other times that'll be a drain on free cash. It's not. I'm looking at this thing over the last 10 years, and it looks like every year it gets some sort of big or small push from changes in working capital. I don't know quite how to account for that in my own head, but it does look pretty consistent here. And as you look at this as a kind of cash machine, which I've heard people refer to PayPal as, and they want to value it based on free cash flow. So we are back at this again here, and the things that people say about PayPal, they want to value it at free cash flow, but the trouble with PayPal is they have huge amounts of stock-based comp compared to their free cash flow. So, I mean, I don't mind if you want to use free cash flow as a metric, but bear in mind you're going to have to spend about a third of it then buying back the shares that you just printed to give to your employees. So we'll knock it down by a third or so, and then it doesn't look so cheap anymore. Adyen, as you rightly point out, is the opposite way around. It looks okay as a free cash flow kind of metric here at the moment, but there is nothing to offset with that. And if it came down to a choice between the two of them at a roughly similar multiple here, I don't think there's any question about which one I'd rather have, to be honest with you, Steve.
No, I agree with that. I think the issue, just to add on to what you said there, Steve, is people get a bit excited about PayPal's free cash flow, and then they also go and look how much they're buying back, and they kind of sellotape them together to get the push. But what they're forgetting is that they issue a hell of a lot of stock and essentially just buy it back, so they end up net neutral in that kind of area. So it's kind of like double adding the push, which you don't get. So largely I think this is a way better business than PayPal. In fact, PayPal have said it in as many words. In fact, PayPal use Adyen for a number of services, which kind of tells you all you really need to know. But the new CEO, the first thing he said was essentially this is not a great product that PayPal have, because it's numerous products that they've bought in, all in different languages, all with different people. You couldn't have somebody who worked at one part of PayPal move to another part and be able to get to work, because the systems are so different and were built completely different by different people at different times and different companies that were bought in. That's not the case at Adyen. It's one unified code base, all written by Adyen. There's not been any acquisitions. And because of that, they're a lot more agile than PayPal. And Adyen and PayPal are now at such a scale that you think, oh well, we'll just rewrite it, but that's not something PayPal are going to be able to do, because the likelihood is that there are large swathes of PayPal staff that don't understand how half of that payment infrastructure works, and the other half that don't understand the other half of how that infrastructure works. So it's a bit of a nightmare, and in the process of rewriting it, you've got Adyen chasing you down like Pac-Man. I think they're expanding aggressively into America. They're expanding aggressively into Latin America. And to be honest with you, Steve, I think there's more competition in Latin America than there is in the US. I think your Mellies, your Stonecos, those kind of companies in Latin America pose more of a problem to Adyen than your PayPals and your Squares and your Blocks and your other acquirers over in the US. So my only worry really about Adyen's growth is I hope they don't swallow Toast's business on the way through. I hope they go straight after PayPal's commercial business, and that would be a very good place for them to go shopping, I think, because they can prove with pretty much impunity that their product is way better.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.